And that net principal limit are the proceeds. So you have that you can take lump sum, monthly income, whatever, but that's how it's calculated, how much is available. Now, if you're 70, you would get less money than if you were 80, because all reverse mortgage calculations calculate as if you're going to be 100 years old. So everybody is calculated that they're going to live out to 100. So I would lend more to an 80-year-old because we have 20 years than a 70-year-old because we have 30 years worth of interest accruing, okay? So a 90-year-old would get more than an 80-year-old, an 80-year-old would get more than a 70-year-old. But that's how the proceeds are calculated. Flexible payment options, like I said, you can get a lump sum, you can get a monthly income. The monthly income can be a specific term, like 8 years, 10 years, 12 years, or we could do it for life. So we could set up that payment option, guaranteed you would get X amount of dollars every month, the first business day of every month, right into your checking account for the rest of your life. Now remember I said that it was going to calculate you living to be 100, right? If you live to be 105, we still have to pay that out because that's a life annuity type, a life annuity. So you would get X amount of dollars as long as you're living there for the rest of your life. So those are the two monthly payment options. There's a line of credit that you can use as much or as little, or we can mix it up. I had a couple in Crawfordsville. They took $5,000 cash at close. They left $13,000 in the line of credit for a future car purchase, and the remainder they took in a 15-year payout. They figured that it wasn't that they were going to be passing in 15 years. They just figured in 15 years they wouldn't be living there anymore, because when I did the loan they were 80. So they figured by the time they were 95 they probably would not be living there. So we guaranteed them $406 a month every month for the next 15 years, and a line of credit and $5,000 cash at close. So we can tailor the payment plan how you want it. You tell us how you want to take the monies. And like I said, you can change that payment plan anytime you choose. Repayment, it's a loan. There's a lien on your property, just like any other mortgage, there is a lien on your property. The difference is, A, you never make a monthly payment, but you must pay back the reverse mortgage at some point in time. And that repayment hinges on one of three life experiences happening. One, if you decide to sell. You can sell anytime you want to, pay off the reverse mortgage, you take the proceeds over and above the payoff and go your merry way, okay? It's your home, you retain title, you can sell it anytime you choose or not to. If you have passed, then your heirs are going to inherit the home, they're going to sell it, pay off the reverse mortgage, they get the proceeds over and above the payoff, okay? The third scenario is if you permanently vacate the home for 12 consecutive months. So during that time, you and the kids need to kind of decide what you're going to do, get the realtor, get the house sold, pay off the reverse mortgage, and get the proceeds to you over and above the payoff, correct? So if you move, sell, or pass away, the loan comes due because you're what? You're no longer owner-occupied. So that's one of the main things. You have to be owner-occupied. But like I said, you don't have to be in that house every day of your life. You can travel, you can visit the kids, you can go on vacation, spend your winters away. It's just the house must remain your primary residence, okay? Now, if perchance you did have to go to the hospital nursing home, as long as you're coming back home, that does not constitute as a permanent removal from the home, right? So, so you can go back and forth, you can move around. It's just when that 12 consecutive months out of the home, that's when the loan comes due. The payback is based on the monies you've received. So let's say we had a $100,000 bucket of money available to you. And over the course of time, you had used $20,000, okay? So we still have $80,000 in that bucket of money, in that line of credit or the monthly income, $80,000 that you haven't used. Your payback would be based on the 20 plus accrued interest. The rest of that 80 just goes back into the equity of your home because you have not physically received it. So your payback is always based on the monies that you have received. Here's the loan process. The blue sheet in your folder really, I think, is the better step-by-step process. But the first thing is education. I feel it's very important that seniors really read about reverse mortgages, that we dialogue about reverse mortgages. There's a good understanding about the program. The next step is counseling. Go through counseling, then we can take the application, go through processing, underwriting, we close, we fund, and then the last step is repayment down the road.